post, and it was fitting that after Tim just got done, which I found to be really interesting material, that we're going to talk about the most requested topic. And given that the market has been pulling back lately, it's sort of timely. It's my favorite presentation to do because it involves hedging risk, and it involves being able to sleep at night and not having to panic and wonder, what lies ahead next. So if you guys have any questions as we go through the presentation, please feel free to write them down. I'll try to pick some off as we go, but I prefer to save the questions till the end just to keep a nice flow. And then it'll last about 45 minutes, and we'll do about a 10 or 15-minute Q&A, so I'll have you out of here in under an hour for sure. So just to give you a real brief bio on myself, if you haven't heard me before, my name is Ron Haydt from MarketTamer. We're a Philadelphia base, so I'm in Eastern Pennsylvania. I've taught, my goodness, I sort of lost track, but just thousands and thousands of folks live in person all over the world and all over the web. I enjoy it. I get a lot of fun out of it. It's important, for me to help others. I enjoy that. Our mission at MarketTamer is to help folks protect their hard-earned capital, and earn income at the same time. It's like, why not? Why can't we protect and earn income? It's a nice combination. So whether the market continues to rise or crash, our members are always prepared not to lose their shirt, but profit from any trend, that they're not scared if the market goes up or down. Again, if you guys have questions, just write them down. I'll take care of them at the end. And let's go ahead and move on to today's topic. We're going to talk about fixing broken trades the MarketTamer way. And this is one of my most favorite presentations, because, in part because of the pictures. So to start with today's topic, accidents do happen, right? They happen in sports, they happen in vehicles if you're next to a cliff. Or gentlemen, I'm just going to skip by that as fast as I can. And this one's for my wife, my new wife, my only wife. But pet accidents happen too. We are cat lovers. So, and then of course, those of you guys that are here today, whether you trade futures, forex, currencies, binaries, stocks, options, stock market accidents happen too. And no matter how good you are, how seasoned you are, you're new or old to trading, every once in a while you're going to find yourself screwing up, where stocks just aren't going to do what you expect them to do. Or you might do everything perfect, and the market just might throw you a curveball. You might say, boy, oh boy, I've done all the technical research, I've done the fundamental research, and something still goes wrong. Well, it actually happened to us too. But, what I want to show you is it doesn't matter when the bad stuff happens, because you know what? We can fix anything, virtually anything. Now, the stock I want to talk about is Facebook. Probably you guys have heard about that one. We actually bought Facebook just to track for our members. And here's the worst part. We were asked about Facebook. We told our members, you know what? Stay away. When the smart guys are selling, you should not be buying. We've seen this happen before. The smart guys sell right at the top. Often, when they bring their company public, it's a great opportunity for them to dump shares. And the same thing happened with Blackstone back in 2007. Blackstone came out in the low 30s, ended up going to $5 a share before it rebounded. Anybody that bought in the opening hoping it would be the next whatever it was going to be was in the house of pain, to steal a quote. So when Facebook came public, we listened to our own advice. It was probably asked more about than Apple, which is strange because usually Apple's always the top of our list of member requests. Facebook took the top spot for a bit. And, when it hit $45, we said, nah, we wouldn't touch that sucker. When it dropped to 40, nope, not going to touch it again. Hit 35, said, nope, how about 30? We started to accumulate a position. We thought, you know what, 30 is close enough. Let's get started here. Let's show folks what we can do. And in terms of picking stock direction, we were absolutely wrong. In fact, within days of just saying, hey, let's go buy this stock, let's have a tracking position, it dropped a third. And then it was down over 50% from its high. This chart sort of tells the story. You can see up here, it was up in the 40s. Now it's at 20. At the time, Facebook acquired the term faceplant. I think that was more indicative of what happened to people that were buying the stock. But here's the thing. Even though we were 100% wrong, you can say, by buying a stock at 30, we weren't worried at all. Not 1%, not one bit. We were 99.9% sure that even though we had that tracking position, we could turn a loser into a winner. How can we be so sure and confident. We've done it before. And what I'm going to show you today is a super simple, it's not hard, hugely powerful method that you can use to turn your stocks into winners too. So I'm going to share with you how you can recover from a really bad trade, turn into a winner. And you should know how to do this because you do it everywhere else, in life, whether it's a doctor, whether it's your pet. If they have an accident, you're going to go to the doctor, you're going to go to the vet. But what happens if your portfolio gets hurt? How do you fix that? Just like a mechanic fixing a car or a pilot fixing a plane, there's always a plan on how to fix something. Because someday, some trade is going to go wrong, no matter how much effort you put into it. We can't have a crystal ball. There's no crystal ball. We can't be perfect. But once the trend starts to change, there are things we can do. I mean, think about it. Would you really let a pilot fly a plane without knowing what to do when things went wrong? It's like, hey, I might be a nice guy, but you don't want me flying your plane. Not unless I've had practice. You wouldn't go to a doctor if you didn't have a plan to get you feel better, to make you feel better. So why on earth would you risk your hard-earned money, your nest egg, something you've worked all your life, without having a plan to fix it if it goes wrong? And the reason you can be pretty sure things will go wrong at some point is nobody has that crystal ball. Murphy's Law can happen. So even though you research a company, like I said earlier, using technical or fundamental analysis, something can go wrong. So once you can admit to yourself that something will go wrong someday, it's much easier to embrace the idea of fixing that broken trade. All you got to do is have a plan. And without a plan, we get this so often. Folks who say, I've been trading for 5 or 10 years, I've bought so many books, I've attended so many this or that, but they still succumb to fear and greed. It's because they don't have the plan. Without those plans, they take losses regularly. But think about it. Think about all those trades. What if you could turn a losing trade into a winner? What if you could take a $1,000 loss and take that back and make it a $1,000 winner? On a $10,000 portfolio, instead of being down 10%, you're up 10%. Now start thinking about all those other losing trades, 1,000 here, 1,000 there. What if it could be flip-flopped? Turning each of those losers into a winner. Think about all the extra money you'd have in your account to trade for income. It's better not to lose, but how do you do it, right? And what do you need to be able to fix the broken trade? There's going to be two key ingredients. It's going to be patience, and there's going to be discipline. We don't act too fast, and when it's time to act, we act accordingly. Too many folks like to take a weekend seminar per se, or a one-day seminar. They were really, really popular back, before 2008, where you take 2-3 day seminars and thinking that you're going to be able to trade instantaneously. And that's just not how it's done. Whether it's Woods, Federer, Gabby Douglas, or whoever the next group of all-stars in sports are going to be, they don't just practice for a weekend and then all of a sudden they go out and win championships. The same thing with business people. You're not going to get rich overnight, and that's key. What I'm going to show you today is not going to get you rich overnight, but it's going to allow you to sleep. It's going to allow you to have discipline, patience, and when it's time to act, we act. Remember that old saying, a jug fills drop by drop. It might seem too slow, but when you start trying to take on large returns, that's when the risk really gets out of control and people find themselves upside down pretty quickly. You don't want to take your nest egg and risk it all in one trade. You want to grow it little by little. So when you look behind you each and every year, you say, wow, all those small things that I did along the way, it really had an impact and it made a difference by year's end. When people say, Ron, how much are you up or what's your profit? I'm like, I really don't pay attention to that. I just want to make the right decision at the right time. And by the end of the year, the whole plan is you have more winners than losers, because nothing's going to be perfect. But you want to keep your risk in check at every turn. So in this following example, we're going to go through this step by step on a trade that went completely wrong. We literally tracked the stock at the high. And you're going to find out how to turn a loser into a winner. And we're going to do it in a way that's going to be very, very easy to follow. You're going to be able to repeat it step by step. I sort of like this slide. It's okay if others want to trade like monkeys, but we can choose to trade a little smarter than that. So now I'm going to show you how to fix a broken trade the MarketTamer way. So here we go. Imagine you just purchased a stock at 72 bucks. Whatever stock, let's just call it XYZ. You can try to guess, but whatever. Let's just call it XYZ. So we bought this little turkey right there. Now I told you we're going to keep this super simple. I do all kinds of trading, by the way. I do weeklies, I do monthlies, I do calendars, I'll do condors if necessary. I'll do all kinds of fun stuff. But this is simple. This is great for folks that are holding stock that want to sleep. So what we're going to do is I'm going to show you the 5-day moving average, which is in blue, and the 20-day moving average, which is in red. I told you it would be simple. Now these are exponential moving averages. You could use simple, but we like exponential. The only difference between the exponential and the simple is the exponential gives the most current price data, which would be today, the heaviest weighting. Because we really don't care as much of what happened 20 days ago. What we care most about is what happened today. What was the news that drove our stock, up or down? So that's why we like EMAs better. Super simple. We have a blue and a red, 5 and a 20. So when the blue crosses down through the red, that is a bearish crossover. So what do we have to do now? Well, let's back up a second. Are you really going to buy a stock today or tomorrow if you really think it's going to go down? And the answer probably is no. We really shouldn't do that. If we felt the stock was going to fall, there's a litany of trades that we could place to optimize a downtrend. We could buy puts. We could short stock. We could do any, bear calls. We could do all kinds of fun stuff. So typically you're out there buying a stock and you say, okay, I want to buy this stock because I think it can go higher. I like what the company does, and it's going to be around for a while. I mean, that's why you buy stock generally, especially for 401kers, people that are looking to hold stocks for long periods of time. Not the scalpers. Hey, listen, I like scalping like anybody else, but that's not what this is about. This is longer term positions. So we get this 5 and 20-day crossover, blue down through the red. It's time to act. Now we have discipline. We waited, we bought the stock right there, and the sucker drops 4 straight days. I'm like, are you kidding me, right? Time to buy a long put. We're going to buy a long put at strike 70, which is just barely above where the stock is trading. And we're going to pay about $5 a share for that option, okay? So now what happened to the trade? Well, we bought the stock at 72. We're now going to buy puts at strike 70, but it's going to cost us some money, and those puts are like insurance. Because even if this stock turned out to be the next WorldCom, Enron, maybe even JCPenney, we always get the right to sell it at 70. So our risk is always going to be fixed while we have this insurance policy in place. So our cost is the cost of the stock, the cost of the put. Well, we paid 72. The put cost 5. Our cost base is at 77. I understand the stock's at 68, but we're going to be fine. Watch how this works. So in this chart, the stock bounced off the same level at which it bounced previously. Now this is a little bit of technical analysis. Basically, what happened here earlier, before we bought the stock, it came down to this level, and traders came in and bought. So they call, that's a support level. It went up. We bought right there, the perfectly wrong day, and now the little turkey's all the way back down where it was. So it hit a previous support level, and look what happened. The stock bounced again. So now I have a question for you guys. We bought the long put up here. The stock has now dropped about $7-8. That long put has appreciated in value. We have a profit. Should we go ahead and sell the long put and take that profit off the table and lower the cost basis in our shares? What do you think? And by the way, there's no wrong answer. So now you're free to type in. You don't have to feel bad about getting anything wrong. What do you guys think? I see Kenny and Jeff, WK, Jeff again. Okay. Fair enough. Fair enough. Whatever your answer is, it's going to be the right answer because it's your answer. But watch what happens. If you decided to bank profits from that long put, which many of you did, you just found out that you are more aggressive by nature. If you decided to continue to hold those long puts, maybe like Marie said, you just discover that you're more conservative by nature. The 5-day EMA in blue never crossed up through the red line, which is the 20-day EMA. No bullish crossover was signaled. The stock dropped another 10 bucks. So it actually did pay to say, you know what? The stock may have bounced at a previous support level, but boy, oh boy, aren't we glad we held the long puts, because those long puts now gained even more value. Now is the time, as we move on to this next slide, we're going to do what WK's talking about. With earnings imminent and the stock at $50, we no longer want to hold those strike 70 puts that we bought many dollars ago, because if the stock jumps up now, it wipes out the put profits. How many of you folks have bought a long put that trade stock only to see those long puts get creamed? I can raise my hand. It's happened to me. So what we learn is when the stock comes into earnings, if we have long puts that have profit and we still think the stock is going to be around in the near future, we want to roll those puts down. So we're going to close those puts, take some profit off the table, but at the same time, we're going to buy a new set of puts just in case some bad news comes out. So it's just called rolling. So let's assume the worst case scenario, that when we sold those 70 long puts that we paid $5 for, the stock's now at 50. So if we bought the puts at 70 and the stock's now at 50, that stock dropped 20 bucks. That's all we can sell the long put for then. So if we pay 5, we sell it for 20, we have $15 in profit. I mean, that's pretty cool. Did it make dollar for dollar as the stock dropped? No, it didn't. They rarely ever will. But 15 is better than nothing. And I'm going to elaborate on all this a little later, because there's more we could even do here. So now what's our cost basis? We bought the stock, or let's do old cost basis first. We paid 72 for the stock, paid 5 for the put. We told you our cost basis was 77. The new cost basis, cost of stock, minus the profit from that long put, but we do have to add $3 because that's going to be the new long put cost at strike 50. So now our cost basis is at 60. So it's still higher than where the stock is trading, but a heck of a lot better than being up there at $72, isn't it? Now guess what happens? Stock has earnings. Pop goes the weasel. Up it goes from sub 55, now it's up to 60. And it actually stayed there for a few days. So now what are we going to do? Well, nothing. That long put's simply going to expire worthless. We're going to lose that entire $3. But look what happened. The stock gapped up, moved higher, came down, moved up again, and then ripped to new highs. So subsequent to the bullish earnings gap, the stock continued higher. Even though the stock did pull back a little bit here and a little bit here, that blue line never crossed down through the red line. So we're just sitting pretty. Now the stock's back up to where it was when we bought it. So let's compare the buy and hold strategy with this really simple adjustment. I told you it would be simple. If we had bought the stock at 72 bucks months earlier, we're break even. You would have suffered a lot of stress. Is that fair to say? Would it be fair to say that you would have probably said a lot of 4-letter words? Maybe one of them was ARG, if you don't use the bad ones. But think about that. How many stocks have you bought only to see it decline, and then you start saying nasty things to yourself, calling yourself names, or, you're never going to get it. It happened again. It basically just ruins your night, because This is money you worked so hard for. You don't want to see it be thrown out the window. You're not even happy with yourself. Maybe your spouse is yelling at you now. Maybe you're yelling at yourself too. But if we had a put that we rode down, and now we're back up here, it's a whole nother ball game. Every night, when you went back, or when you went to bed, you went to sleep, you knew that no matter what happened, even if this stock went to zero, you always had protection. You knew that your risk would only have ever been $7. Okay, we just did buy and hold. You didn't make a dime. You lost a lot of stress. But how about the married put way? Lower risk, lower stress. We made 12 bucks a share. Remember we made 15 bucks on that long put? But then we did have to pay $3 for a new put, so 15 minus 3 is 12. If you had 500 shares of stock, you just made 6 grand. The stock didn't go anywhere over a few months, except maybe you lost hair along the way. But the person that used a married put, yeah, they made $12 a share. 1,200 bucks per 100 shares. And now the stock's back where it was. Then look what happened. The stock went to new highs. The keys in this trade were following the rules. We did not want to panic in a downtrend. We recognize that gains are not made overnight, but that substantial gains can be made over time. Holding this stock through earnings, riding it up, look what happened. You now have a 50% gain in 7 months. And you had no worries. You had no concerns that your capital could be wiped out overnight. In this example, we only looked at employing the long put option. That was it. It is possible to even further reduce risk by using call options. And that's what some of you folks were saying. Teresa was one of them, and there were a few of you others that said, hey, well, why don't we use short calls? Well, now we're coming to it. And even this approach, keeping it so simple, not inflating the values, we're actually using low values, though returns could actually be higher because we're not even counting the extrinsic value. Now that's getting a little grainy, but these aren't pie in the sky numbers. These are actually numbers that actually hurt the ROI I'm showing you. So it's bare bones data. So going back, remember we bought the stock right there? We got that 5 and 20-day crossover, blue down through the red. We can now start to sell short calls. We could sell one short call for every 100 shares of stock. Let's say we go out maybe 3 months or so. We sell a short call for $3. That $3 or $300 per contract, that money's put into your account. No one ever can take it away from you. It's yours. Your obligation, however, would be if the stock exceeded that price, you have to get rid of your shares. So is there any dividend risk? No. If the stock is below the short call value, unless the dividend is insanely high, no, there is no risk. Nobody's going to want the stock. So the short calls can simply expire worthless, and we sell them out of the money. So WK, that alleviates that concern. Now, before earnings, the call options that were initially sold can be bought back, or they may even expire worthless, which would lead to a maximum gain of $3. When we take stocks into earnings, we want protection. And keep in mind, the only reason we really have the stock is we're expecting a bullish trend at some stage. They make a real product. If they're not going to be going out of business, otherwise, if we knew they were going out of business, we wouldn't have bought the shares in the first place, right? So when we get prepared for earnings, we buy that put, but we no longer keep a short call. That way we have unlimited upside potential. So when that stock gapped up on earnings, and you see how the blue line crossed up through the red line, there's no longer a reason to sell short calls if we don't want to. I told you this would be simple and easy. You just sit back and enjoy the ride. Some rules of thumb. When a stock is in a downtrend, we sell calls against the stock. When technical levels fail, specifically support, we sell calls against the stock. And then prior to earnings, ideally, we like to buy back those short calls so our profit potential remains unlimited. Selling calls in addition to the married put adjustments means that our percent return on risk will actually increase because the risk declines every single time a short call is sold. Remember, in this example, we went out 3 months. We actually used quite a bit of time. You could use monthly calls, even weekly calls, and actually increase that return. But this is the slow and steady approach. We are now profitable by $15 per share. Instead of being profitable $6,000 on 500 shares, we're now profitable $7,500 on 500 shares. And every time we add a short call, our cost basis in those shares, in our minds, will continually be reduced. The IRS doesn't look at it that way, and options are, the option profit's going to be categorized differently. But you keep selling calls against your stock when they start to stagnate or they start to go down. Over time, you end up reducing your cost basis lower and lower and lower to a point where the stock's like a rent-free property. So we love treating stocks like rental units. Hey, when they're in uptrends, let those turkeys run. But when they don't keep going up, time for them to start paying us rent, not to mention the dividend. So I promised you a super simple methodology. You now know how to fix a broken trade. Take that 5-day EMA and 20-day EMA and map it out on a stock that you have. You like stocks that have flow to them. We don't like stocks that are jumping up and down, left and right, that can't seem to stay in any in any range whatsoever. Stocks that trend are awesome. This strategy can be applied to virtually any stock. So again, you can fix a broken trade even when it goes against your expectation. So beyond the simple yet powerful strategy I just demonstrated, other extraordinarily powerful techniques also exist where you guys can maximize gains and minimize losses. It's our specialty at MarketTamer. We showed you a married put adjustment, even actually turning into a collar trade briefly. But how about other spreads? What if you guys like to do bull puts or bear calls? How about ratio back spreads? How about condors, butterflies? Are there ways to fix those trades too? You bet. But you don't need to be a master of them all. But what you want to do is start with one. Start with one strategy that you like. When I first started learning about options 12 plus years ago, I wanted to learn it all. I love learning. And it became incredibly overwhelming. And there's no reason to do that. You start with one strategy and you go forward. So what Gareth and I did is we put together these videos, and you're going to hear Gareth's voice in them all. There are 40 of them. They're professionally done. We took from what is an option, because I had such difficulty learning options. I almost gave up 4 times, countless times. And everybody tried to make it sound so darn difficult. It's almost like you thought you were operating a nuclear submarine. I'm like, really? It just can't be that difficult. So if you're new to options and you want to learn more, we start out really simple. Then as you begin to build on that, we start talking about more advanced strategies and going into adjustments. So with these 40 on-demand lessons, they're broken into 10 modules on your screen. You can pause them, rewind, fast forward. You can search by keyword. You can read the notes that we have typed in. So it's a full learning process. Like I said, we cover what the basics are of an option. We talk about the Greeks. We teach you how to do fundamental and technical analysis. We talk about income trading, how to exploit volatility and understand it too. Portfolio management, which so many folks need help with. How to establish exit points, including scaling in and scaling out of options. There is a lesson in there that is worth its weight in gold. We have trades called the Amazing Lazy Trade, the Wheel of Profit, which is our secret recipe. And like we talked about today, fixing broken trades. So for example, in one of the modules, one of the 10 modules, it talks about doing covered calls. If you own 500 shares of Apple, and that could be a lot of money to some people, it may not be a lot to somebody else. You just sell 5 call options on a monthly basis, you can put over $5 grand in your pocket. What if you had just 100 shares of Apple? How does $1,100 sound? You can do it each and every month if you want to be proactive. And if you just want to sit back and enjoy the ride higher, and you don't want to sell short calls every month, you could sell short calls every few months. Or do nothing and just ride the stock. Module 4 does rock. We call it rock solid income trades, but it talks about using time decay to your advantage. Using primarily for income. Remember, professionals, they're generally not buyers of options. They're sellers of options. You know, it's the 3 certainties in life: death, taxes, and theta. Maybe we should add number 4. We'll add in NSA spying. But the death, taxes, and theta thing, every day you own an option, it decays. It's working against you every darn single day. But when you are a seller of those options, it erodes in your favor. And that's the side the market makers like to take. That's the side professionals like to take. So we have Module 4 dedicated just to that, the credit trades. And when people watch our modules, they come back, it's one of the ones that they rave about the most. They're like, wow, you typically get lower percent return per trade, but it's a much higher probability of winning. You don't need that stock to go in just one direction. The stock can go in multiple directions. How many times have you bought a call or put on an option and it did not go immediately up or down? And then I would say to you, well, what if I took the opposite side of that trade? How would you like to be the person that sold those options and is collecting premium day by day? How cool would that be? Now the stock can go up, down, sideways. It can go in multiple directions. Modules 9 and 10, gang, that's what we talked about today. These are our adjust to win modules. You can adjust stocks, or in module 10, you can adjust options. They are very, very powerful stuff. So there's 2 philosophies. One is opposite the other. You can take losses, move on, and just take more losses and keep using those stop losses to no avail. Or when a trade goes against you, you turn losers into winners. Understanding how to realize that the trend has changed and what you can do from profit to profit from it is what's priceless. When that trend changes, it's time to adjust our trade. Just because we have a stock like Apple, Walmart, or whatever it might be, and why it might be a good company that's going to have great growth ahead of it, Priceline, whoever it might be, just because it goes down a little bit doesn't mean we have to dump it. And then you end up getting in and out and in and out, and you never end up making any money. There's things we can do to fix it. When we built these modules out, we also put quiz questions in where you guys can actually watch the module, and it's done in Articulate, so the technology is fantastic. You then take the quiz and say, hey, did I learn what I was supposed to? Did I retain that knowledge? You get priceless feedback. Now, for what we did for Morgan and everybody here at the TradingPub, we have a special package for you guys. You're going to get access to our market forecast videos, our stock chat and trade review, which is frankly priceless because you guys can actually list your trades in there and say, hey, I watched your modules. I watched the lessons. Is this how I actually would do that trade? You put it in there, and then we'll give you feedback and say you nailed it. The structure looks great. The entry looks great. The exit looks great. Go ahead and put that in a paper account and watch it go. So you can actually get feedback from us, our coaching staff, to make sure that you're learning the material. We talked about already is the 40 on-demand lessons, the quizzes. We have wealth path coaching, depending if you want to be an aggressive trader or a lower risk trader. There's different paths you can follow, and you can watch live coaching calls with them. You also get the market outlook on every Monday night, hosted by yours truly, where you guys can actually ask questions, look at the market, and we do it together. So I told you I was going to keep this short and stay on point. So we finished up plenty early. Here's the deal. It's $14 for 14 days. And it's a TradingPub special where you guys are going to get access to all of that, even including the weekly 3 live coaching calls. You can watch those videos, learn more about it, ask questions while you're testing us out. and get feedback on the spot. Okay? So we'll have this up. Today is Thursday, and I know Morgan is going until tomorrow. So what I'm going to do is we'll make it good until Saturday. So that gives you guys a chance. If you need to run out and grab the kids, if you're on the East Coast or in the Central Time Zone, whatever, we'll make it good till Saturday. It's $14. It's for 14 days. You can cancel at any time. It's only $97 a month thereafter. So it's super, super simple. Super simple to do. All you do is send us an email at cs@markettamer.com. Okie dokie. So it is 2 weeks. Is that enough time for you guys to demo? Is 14 days enough time? You tell me. Okay, it's not enough time. Only one person had the guts to say it. All right. All right, here we go. So here's what we'll do. I will make it. I'm going to put it here in the chat. So it is noted. Hardly enough time. Well, holy mackerel. Are you sure? So here's what we're going to do. I will do this just for you guys. If you want to try this out, okay. If you want to try this out, here's the deal. It's on the recording. Morgan knows about it. Well, Morgan doesn't know about it, but he knows about it now. Here's what I'll do. If you want to sign up for the trial, I'll make it 30 days. So here's how it's going to work. When you sign up for 14 days, you're going to be sent an email saying, hey, after 14 days, you're going to be charged $97 a month. What I'm going to do is your account's going to be reset, and you'll be granted 30 days. When we send you a reply email, it'll have the date that you are scheduled to be charged, so that way you can bookmark it in your calendar. And if you don't want to continue past 30 days, you can just write us a cancellation letter. Send us an email and say, hey, Ron, thanks so much. I know you doubled the amount of time we were supposed to get, but it's just not for me, and we'll take care of it for you. So now you're getting $14 for 30 days. What does that work out to be? That's got to be like less than 50 cents. It's 46 cents a day. So I think that's hardly too much. One of the things that Gareth and I love to do is teach. We love helping people because when I first started trading, I was very, very lost. Just didn't know what to do. Didn't know who to read, what to read, because everything was so darn complex. People just, I don't like to say dumb it down, but gosh darn it. Why does everyone need to make options trading so darn hard to understand? It's like, do you really need to know what rho is in Vega to be trading options profitably? Actually, the answer is no. I was trading options and doing just fine, not even understanding the Greeks. Do the Greeks help? They sure do. But especially given my background, which I didn't really, I don't think I really told you guys. I never went to college. I never went to anything in finance. And how I got involved in the market was I was listening to my father talk to his broker, and he put his, he didn't have much savings, so he put money into his account. The broker lost half the money on recommendations. So my dad was down to, I think it was $4,000. So he called up the broker and said, hey, I'd like to learn more, or not learn, I'm sorry, I'd like to do another stock. And the broker said, I'm sorry, but unless you put $5,000 in a trade, I won't talk to you. My dad said, well, I did have $5,000, but you lost it, so I'm down to $4,000. That was all my money. And he actually hung up on my father. And that was actually the point where I said, that is the end of that. So I actually started going out and trying to learn about options on my own. And then read a lot of books, did different things, tried and error a lot. I don't know how many folks said it, but I actually blew up my trading account twice and almost did it a third time before I sat myself down and said, enough's enough. What is the definition of insanity? It's doing the same thing over and over again, but expecting a different result. So I like things simple, so that's how we keep it. So anyway, enough. I think that's enough background. And I spent 17 years in retail. So I'm in tune with customers, so I do like trading some retail stocks and things like that. But and I apologize, that's my cat meowing. I think she's jealous that I'm talking to you guys, so I do apologize if you hear that. What do you guys get for the deal? Let me go back and do that for you. Hang on one second. Since we're doing so good on time, I do have a habit of talking fast, so I hope I didn't talk too fast. The website is this. It's MarketTamer.com, but what you want to do is, see, what you need to do is, you need to go through that link that Morgan's putting up there, because you're going to get the bonus. You're going to get an extra bonus of 16 days. So if anybody doesn't go through that link, you're not going to be tagged with Morgan's private deal that Morgan doesn't know about, but he does now. Here's what you get. The market forecast videos. So I put a video up every week. You get access to the stock chat and the trade review. So you guys can actually listen to the modules and say, all right, Ron, I listened how to do a bull put, or I listened how to adjust that trade. This is what my plan is on this trade. Am I understanding what you guys are teaching? And then we'll actually comment on that and give you feedback directly. So it's always from an educational standpoint. You'll get the 40 videos that we talked about already. You're going to get the quiz questions, the wealth path coaching, and then three live weekly webinars. 2 are going to be specifically on education, and 1's going to be with me on the market outlook. So after 14 days, what happens is you get charged $97 a month. But with you guys, you're getting to go 30 days and then get charged $97 a month. So you're getting like a doubly good deal, and you get all that for 97 bucks. I know it's too cheap, but it is what it is. We took the Walmart approach to pricing. All right, so while you guys are thinking about other questions, I'm just going to scroll back up because I don't want to miss anybody's questions. Let me see here. Let me start with the 30-day timeline. Chris, that is correct. You get all that for 100 bucks a month after 30 days. So like I said, we'll actually email you back with a date of when you would be charged in the future, so you know when that is. Teresa, we actually do weekly options. We also have a live trading room that focuses on weekly options, where folks can actually follow along with us while we do weekly trades. So yeah, I like weeklies. Now, just sort of off the topic of today, when it comes to weeklies, my goodness, 9.5 out of 10 times I'm a seller. I never want to be a buyer, because you literally have to be right. And how many times can you say in a trade, you're going to be right? It's very, very few. You need time. So I want to sell weekly options. Typically, like to sell them when there's only a couple days left, 3, 4, 5 days. So when the new weeklies come out, on that Thursday for the next week, I generally don't like to sell that time yet, because there's not much decay. The real decay kicks in during the final couple days. All right, let's see, what else do we got? Oh, Sophie, why, thank you so much. Giles, it does. Sam, you're welcome. Oh, thank you, Deborah. Okay, Ken, I typed in the address. Oh, Mike, when I was putting money in, when I first started, I didn't have any savings or anything, so I was putting 2K, 5K in the account and just blowing them up, which, $2,000 to me is always a lot of money. So I became proficient at blowing up accounts, which is not something you really want to be good at. And then I finally sat myself down and said, you know what? You better do something different, or you're not going to do well. In terms of brokerage accounts, you can pretty much use anybody that trades options. We do have a favorite broker. We like TradeStation, but whoever you like is fine. I wouldn't steer you away from anybody. There's lots of great brokers out there. W, When's the best day to buy weekly options? Well, geez, to me, the best day to buy weekly options is almost never because I want to sell them. I want to be a net seller, so time decay is working for me. But typically what happens is, well, actually, today is Thursday. Oh, we can use today's numbers. Okay. So imagine you're looking at an options chain. Pick up anything. And if a stock has weekly options against it, the options would have come out today and they'll end next week. But what you typically see, though, is Thursday, Friday, nothing happens. If the stock really doesn't move, there's almost no decay whatsoever. And then by Monday and Tuesday, you start seeing that decay. So a lot of weekly options that I'll look to do if I want to sell them is actually not now. I'm going to wait till Monday or Tuesday. Oh, if you need an email address, sure, I can put that in there. If you have any questions, you can email me, cs@markettamer.com. CS is just customer support. So W, I hope that answers your question. So in theory, W, if you're looking to buy an option, then literally Thursday, Friday is the day to buy them and look to dump them right away. But I just don't want to do that because the odds are so small. You literally have to be exactly right in which way that stock is going to move. And that's tough to do. Therefore, I want to be selling them. Because the stock goes nowhere, you are just collecting premium bucket by bucket. Okay. You guys, we still have some time here. I can answer any questions if you guys have any. So far, you guys have been tons of great questions here. I hope I didn't miss any. If I did miss something, please go ahead and type it in. And here's that special deal. Remember, you're going to get not 14 days, but 30 days. And how you know I just made that up is when you go to the buy page, you're going to see 14 days. That was not part of the deal. But we'll send you an email and confirm it with you that you do indeed get 30 days. All right. Hey there, John. How you doing? John, I tried to do a 40-45 call credit spread and also a long. Yeah, you can't have a long and short option at the same strike price in the same expiration month or in the same expiration cycle is the proper way to say it. So, John, what I prefer to do, it would be called an iron condor, is you sell one call spread on one side and then sell a put spread on the other. And then you can have a short option at the same strike, but one will be call, one will be put. And we talk about that in those videos. I think you would find those helpful. W, do I wait for a down day to sell options? You know, it depends if I'm selling calls or puts. Me personally, I don't like to leg into iron condors because it's one of those things where you can make money in iron condors, 8, 9 times out of 10, and it only takes that one time and it just blows up your account. So if I do iron condors, it's because I leg into them. So stocks, had been in uptrends recently. I prefer to do bull puts, vertical credit spreads. But then when stocks start to run into a previous resistance level, then I'll put on a bear call. But I don't really like to put on a month-long bear call on stocks that go up. You're sort of fighting the trend, and why would you want to do that? It is how I look at it. Let's see there. John, oh wait. Okay, I answered your question, John. Moving down to Irene. Do you adjust close out when the stocks move towards your short options? You betcha. When stocks begin to move against you, meaning they start moving towards the short option, then we'll begin to adjust. But Irene, we don't use like a specific percent. There's some folks that will use deltas. We won't go that granular all the time. I like to use other things like confluence of resistance or support on the chart. I think that gives us even better probability of the stock stopping at a certain spot. But yeah, if the stock begins to move too close to a short option, then we need to adjust. And typically, we'll look to roll those out in time or add additional long options and turn it into a ratio back spread if necessary. But we'll typically do that, before the short gets in the money. Again, that's a more granular term, but hopefully that helps. I'm trying not to make things sound too complicated. Hopefully I'm doing pretty well. Giles, I hope I'm saying your name right. I don't know what exactly you would like to trade, so I would do some research on Canadian brokers. Since I'm from the U.S., I'm really not the best person to talk to. I know TradeStation, Thinkorswim, Options Express. I know they had done business in Canada. I just don't know what they do. Okie dokie. Moving on down. Hey there, EB. I don't know anything about options. How will reviewing 40 modules help me not be overwhelmed? Well, in 30 days, you watch all 40 lessons, you would be overwhelmed if you don't know anything about options. That would be anybody. So what you want to do is, and I'll just be, tell it like it is. If you're new to options, what you would want to do is you're going to start with module 1, 2, and 3. And over the course of the next 30 days, you watch those 3 modules. And if you think that those lessons inside those 3 modules are making sense to you, then you'll know if you want to continue and pay $97 a month. So all you need to, don't worry about modules 4 through 10, there's no point, because you will be overwhelmed. But if you're understanding modules 1, 2, and 3, then you know you're on the right track without spending any additional money. How does that sound? Module 7 is also very interesting because it has the short-term trading system in it, 7 and 8. All right. Just reading down here more questions. All right. Okay, Jim B. Jim B, I'm sorry, I don't know what you mean by 2 separate orders, so just let me know. I'll be happy to comment on that. John F., the short answer to your question from earlier is you can't be long and short the same option because one cancels the other out. I know where you're coming from because I asked that question myself. I considered it like a SKU number, sort of like when I was in retail. I'm like, why can't I have one of these and one of them? And it just doesn't work that way. You can only be long or short one of them. If you try to do it the other way, it cancels it out, just the way it works. One undoes the other. W. How long do you wait before you adjust a bad trade? It could be one day, or it could be a couple days. We need confirmation. And the 5 and the 20-day EMAs, typically for 1 month long credit spreads or longer term directional trades, stock or options, that's a good way to start getting a litmus test on the stock. So each trade is different, but each one's going to have an adjustment point. I mean, there's so many different types of trades out there. The one we showed you today was stock and option based. It was, hey, we have a stock, now we need to protect it. Hang on 1 second. There we go. All right, just looking here for more comments. I'm going to have to raise this chat box for me, just so I can see more of them. Oh, hey, Jack W., thank you so much for that. Jack said it's the best dollar value I've ever spent on options education at MarketTamer. Jack, thank you so much. Now I owe you a Starbucks. Okay, Dan, thanks for commenting on John F's question. Sophie, that's great. Thank you so much. I appreciate that. Yeah, you will have access to live coaches, in the classes, so you can ask questions. Plus, you get to email us. So you really are getting a super duper deal here, which is not a public deal. Nobu, once you log in to MarketTamer.com and you've signed up for the trial, you're going to click on Video on Demand Lessons. That's where you're going to go to. Video on Demand Lessons. Okay, Robert, you're welcome. EB, you're welcome. Marie, gotcha. Joel, what happens is it's going to be $97 for each month after your trial ends. You can cancel at any time. Some folks go on vacation. They ask us to put their membership on hold for a month, so they're just not wasting their money. And then when they get back, they reactivate it. So that $97, that's every month. And you're going to get 30 days for your $14 trial. Remember, I'm going to have to email you. They're going to start emailing you tonight and tomorrow. And they're going to give you, let's just say tomorrow. That way you don't have to be checking your email. So tomorrow you're going to get an email from us, and it's going to say, hey, hey, Joel, you had a special deal. You're not going to get 14 days. You're going to get 30 days. And here is the date of your next charge. If you'd like to cancel, please do so by this date. So it'll be very, very straightforward and upfront. Giles, the same thing that we showed on that other stock. It went down and went up, so it turns out to be a winner. It's a nice thing. That's why, we don't want to buy stocks that are overvalued per se, just because why would you buy a stock if it's going to keep going down, right? But at some point when you think it's close enough to the bottom, we can actually enter a little early. Sometimes entering early is brilliant. Other times not so much. It might go down a little bit, but we can still use options to hedge our risk. There's no reason to sit there and just hold a stock and just watch it go down and, get upset or lose sleep over it. Corwin, how far out do we go with long puts, married puts? Typically, 2 to 3 months is generally enough time. That's typically enough. We don't have to go out real far because, stocks will often go up in escalators and down in elevators, so the downtrends typically are pretty quick. But, 2-3 months is usually a nice sweet spot. John F., do I sell naked calls? No way. I'll tell you my bad joke. There's lots of things we can do naked, but that will not be one of them. Naked calls have unlimited risk. Naked short stock has unlimited risk. For the life of me, I do not understand why people feel the necessity to do those. That's just me. Because if you get caught in the wrong trade, you can have your account blown up. I have a friend who had a friend who shorted Burlington Northern before Warren Buffett took it over. He was short an individual stock. He blew up his whole account, lost everything. Do you really want to wake up someday to lose everything? And my answer is no. So there's lots of professionals, awesome traders that do naked calls and naked stock, and that's fine. Naked short stock. I'm just from the book of I can't sleep at night. That's something that I have a personal problem with. So if I wanted to short stock, I would always buy a protective call, even if it's only a nickel or a dime, something so cheap it's the price of a coffee or something. That way, if something bizarre does happen, that guy wouldn't have lost everything he had. Still would have got a beating, but you wouldn't have been dead, so to speak. Ken, is it cheaper to be in options or stock? Well, it depends. If you buy stock, it typically is going to cost more money than an option. However, if you buy options that are what's called deep in the money, the cost structure could be quite similar. Now, typically most options are bought near where the stock is trading. So as a result of that, it would make them a lot less capital intensive, typically speaking. How do we pick stocks to sell options? Well, W, we can share our watch list with you. You can follow some of the stocks we follow, or you can pick your own. We love trading Apple, ISRG, First Solar, IBM. There's different ones out there. I like the gold miners. I'm a huge gold and silver bull. So I love trading GDX, GDXJ, SIL, GLD, SLV, Newmont, Silver Wheaton, Royal Gold, you name it. Oh, I'll tell you what, Joanne, use this email address, drop me an email, and then as soon as I'm done, I'll get right back with you, or Misty or Curtis or Carrie can get with you. They might even be on with you already. Julie, what do I cover in the chat room? Well, it's not per se a chat room, like it's not open all the week, all week long. Monday nights at 9 p.m. it is open chat. So what I do is I talk about the markets for about 15, 20, 30 minutes, highlight what support and resistance levels to look for in the week ahead, but then I also cover gold, silver, the miners, the VIX, bonds, oil. Currencies not so much because I don't short trade currencies, and the long-term picture is they're all in trouble. It'll be the pig with the best lipstick left standing, which will be the dollar. But long-term currencies just sort of look down for the most part, so we don't talk about that. And then the remaining session of the hour, the other half hour, you guys get to actually type your stock in or even a trade idea you have, and then I explore it with you and talk about, what is the trend, what to watch for if the stock were to change trends. All right. Yes, the market outlook is at 9 p.m. That is Super Bowl Sunday. So I guess it's a good thing the Eagles don't play every Monday night. Otherwise, I wouldn't be doing it. Can you do options with the indexes? You sure can. Now, the SPX, the RUT, there's large bid-ask spreads in there. So I prefer to trade spiders, the diamonds, the IWM. Zafar will welcome. Awesome that you took the offer. I don't know how many did take the offer. I haven't looked, so I'm hoping I'm going to have a whole bunch of emails to respond to tomorrow because it is an amazing offer. And then Nouveau, do people sell naked puts mostly to get stocks they want as a discount? Yeah, I'm okay with a naked put. I do like spreads because the capital requirement is a little less and it does protect you just in case stocks fall off a cliff. But I'm happy with naked puts and bull puts. And the risk graph of a naked put and a covered call is pretty much the same in a sense. So, I think it was Tim that was saying it, that he likes to do that too. Same here. Like, especially the miners. If the miners were to pull back again, doing bull puts on GDX and picking up an ETF at a lower price, I'm on it like white on rice. Or like ketchup on eggs, whatever you want to call it. Cool. Oh, Fred, any reason I don't trade Forex? You know what, Fred? I'll trade a little bit of futures. I'll trade, but primarily it's stock and options. You could trade everything, but I just don't need to. So I have nothing against trading Forex other than I would never, ever, ever want to take a Forex trade through a closed session if one would ever occur type of thing. So I'm fine trading Forex if you want to be in and out as long as there's no gaps in trading. Because I think with the currency crisis around the world, everybody's printing, there's going to be some crazy stuff that's going to happen. So yeah, it's fine. I have nothing against it. I just don't do it. Stocks, options, and some futures. Tom, I do. Because I started with a small account, I think I know pretty darn well what it takes to make a small account grow. So I think, at the time, $2,000 and $5,000 was the world to me because that's all I had. So you end up having to take more risk per share a little bit, but you just have to do smaller. You can't put half your money in one trade. It's too dangerous. And no, I do not trade binaries. Nothing wrong with binaries either. You just stick with what you have fun with, and for me, it's fun. Nothing against anything else I don't trade, but I like to stick and focus stock and options. So, holy macaroni, I didn't realize I just talked for about a half an hour. I guess I am long-winded. I thought, Morgan, I'd be done 10 minutes early and everybody could go grab that Starbucks for 10 minutes, but I'm going to end it. Morgan, thank you so much for inviting us over. Your group is one of the best groups I get to present to. So anytime you need me, I'm here. I appreciate all their questions. They're always awesome. So have a great day, folks. If you need anything, drop me an email. We'll see you later. Bye-bye.
All right, everybody. Thanks, Ron. We always appreciate you being here and doing an